Well, hello everyone and welcome to Moementum channel. Today we have a very special video for you. We are going to take a look at two undervalued financial stocks with fast dividend growth. These companies are particularly of interest because both of them are actually considered to be Canadian companies. Nonetheless, both of these companies are actually available also in US dollar stocks through New York Stock Exchange and available for investors from overseas. And in a moment, I'm going to tell you why these would be great options for many dividend investors. So let's get into it. The first company to review is Toronto Dominion Bank with ticker symbol TD, and as indicated, available on New York Stock Exchange for those investors from outside of Canada. Toronto Dominion Banks has its history going back to 1855, and today it is one of the North America's largest banks. In fact, the company benefits from generating about 60% of its net income in Canada, where, in fact, the banking sector is especially favorable. Canada's banks are known for their stability, even being able to sail through the recession years of 2007, 2009, where global financial crisis has hit heavily the financial companies. The Canadian banks actually sailed through it without problem. In fact, no Canadian banks failed or required to have government bailouts. As you notice here, TD does pay a dividend yielding 3.64% at this time annually, and it has a market capitalization of $139 billion, making it a mega cap company. We promise that we are looking at companies with fast dividend growth that are undervalued. In this case, TD last increased its dividend in December of 2021, and it increased it by 13%, making it a very fast dividend grower in that sense. What's more, from a volatility perspective, TD's stock has a beta score of 0.76, suggesting that given that this score is less than 1, the stock is less volatile than the overall stock market. It is worthwhile mentioning that as a Canadian company, dividends paid by TD to US investors are subject to a 15% withholding tax. However, investors can avoid this tax by holding their TD stocks in a retirement account or otherwise by using some additional paperwork to claim a tax credit. Be sure to consult an accountant or tax advisor in that matter. It is worth mentioning that Canada hasn't had a banking crisis since 1840, largely due to strict regulations that protect the largest banks in Canada. And according to Department of Finance Canada, the country's 6 largest banks, which TD is one of those, command more than 90% of market share, resulting in pricing power and a more rational competitive environment. While banking is complex and cyclical industry, those investors in TD can rest assured of a solid business given its unique circumstances and unique moat around this company. Let us continue and take a look at some of other key metrics when it comes to dividend for TD. This bank has a payout ratio of 40%, which is a little bit edging higher for banks, and their forward payout ratio is at 44%. For us, a dividend payout ratio between 20 to 60% is considered to be acceptable and a reasonable range. When it comes to dividend growth, if you look at the past 5 years, on average, the company has increased its dividend 8% per year, making it still a fast dividend grower in that time span. And over the past 20 years, they have increased their dividend annually by 9%, maintaining that fast dividend grower status here. While their stock did poorly in terms of recession return between 2007 and 2009, and the stock going down by 63% worse than that of S&P 500, their sales or revenue was actually stagnant, and during those years they did not budge. And of course, as we know, the company did not cut its dividend and continued to, in fact, increase its dividend for the past 11 years. Of course, they had a little bit of that stagnancy in their dividend. You can see between 2008 to 2010, they fairly stayed their dividend at the same level, but they didn't cut their dividends. In fact, they have been paying their dividends for the past 27 years. TD does pay its dividend quarterly, and currently their annual payout is at $2.78 US dollars. Here we are talking about all the metrics in US dollars for investors outside of Canada. As indicated, of course, the company is traded also on Toronto Stock Exchange for Canadian investors. So be sure to check out if that's something that interests you. From a valuation perspective, TD's current dividend yield of 3.64% is about in line with their 5-year average of 3.786%, suggesting that the stock may be reasonably valued today. If you look at their forward price to earnings ratio of 12.2, it is well above their own 5-year average of 10.6, indicating that stock looks somewhat expensive compared to how the market has valued in the recent past. But it could also suggest that the company has actually done quite well in terms of raising its earnings and how it's performed, raising the expectation for the company and how the investors generally perceive the company. It is worthwhile mentioning that the last trading price of the stock is trading close to its 52-week high price, whereas the 52-week low price for the stock was only at $56.26. Looking at a number of other financial metrics, let's start with earnings per share. Ideally, here we would like to see companies that consistently and steadily increase their earnings per share year after year. In 2020, which was a challenging year for many, many businesses, TD earnings per share was actually hit. And nonetheless, they have recovered nicely in 2021 with the earnings per share of $7.91 reported, which is the highest in the past 10 years. And the next 12 months, they are estimated to have an earnings per share of $8.07. In terms of outstanding shares, ideally we'd like to see the companies that decrease their amount of outstanding stock shares in the market. Here seems to be the case as well, with the exception of 2021 that had the lowest. There has been some issuance of share in 2021. In the last 12 months, overall, the company has 1.82 billion outstanding shares. As for revenue or total sales, would like to see a steady growth. The story seems very consistent with that of earnings per share, except for the year 2020. Every year in the past 10 years, the company has been able to nicely increase their revenue, with the last 12 months reporting $42.9 billion in total sales. Lastly, looking at return on equity, here for financials sector companies and for banks, would like to see a return on equity of 9% or above, and TD has checked that box with all the past 8 to 10 years, well surpassing that return on equity metric and number. Let us take a look at the stock performance and the stock return. In the past 1 year, as shown on the graph in the left side, the stock has done a massive 35.24% return, which is just incredible. And in the past 5 years, overall, they are showing a close to 50% return. Not bad at all, again, for investors investing in the stock in the longer term time horizon. It kind of reminds us and shows how when it comes to solid companies such as Toronto Dominion Bank, when the stock performs poorly, such as let's say in the year 2020 or during the recession years when it was down by 63%, how those times could be actually amazing time opportunities for investors to actually get in to the stock, because for the most part, as we see, the stock has recovered very quickly and has recovered very, very well, with massive returns for patient investors and those who are opportunistic in that sense. Let's take a look at some of the other data that we have here in terms of price projections for this company. For Toronto Dominion Bank, there are 11 analysts on tip ranks covering the stock, with 6 of them have a buy rating, 4 of them having a hold rating, and 1 a sell rating. On average, giving it an upside of 8.101%, with a price target of average $82.41. Analysts on Yahoo Finance have a price target of $84.34 1 year. And lastly, looking at valuation metrics on Simply Wall Street, according to analysts there, the fair valuation for the stock is at $94.14, suggesting that stock is undervalued by 19%. Before we move on and take a look at the second undervalued financial sector stock, I have a big favor to ask you. I've put a lot of time and effort to put this video together, and I really appreciate it if you can give this video a thumbs up and share it with someone who would benefit from the video. And of course, subscribe to our channel for more investing and finance related videos. Thank you. All right, let's take a look at the second undervalued bank. Another Canadian bank as indicated, but it is one that is available for investors outside of Canada through availability on New York Stock Exchange. This one is Royal Bank of Canada with ticker symbol RY. Royal Bank of Canada has its history going back to 1864, and the bank actually currently generates around half of its income from personal and commercial banking, including home mortgages, checking and savings account, mutual funds, credit cards, auto financing, and personal and commercial loans. Investment banking and wealth management services drive the rest of RBC's earnings, with smaller contributions from insurance products and investors and treasury services. Their last increase of dividend was in December of 2021, whereby they increased their dividend by 11% compared to the year before. The company does pay a dividend yielding 3.56% annually, and it has a safety dividend score of 80, making it a safe dividend payer. The market capitalization for Royal Bank of Canada is at $150 billion, making it a mega cap, and the stock has a volatility score of 0.72, again suggesting less volatility than the overall stock market. Looking at a number of other metrics, in terms of payout ratio, it has a 39%, which is considered low for banks, and the forward payout ratio is 43%. Again, falling within that range of 20 to 60% for dividend payout ratio that we are treating as acceptable range for us. The Royal Bank of Canada's 5-year dividend increase was 6% annually, marking it as average, and the last 20 years annualized increase of the dividend was 10%, marking it as a fast dividend grower in that sense. During the 2007-2009, their sales was down by about 8%, which was above average compared to many other businesses that did much more worse. And their stock was down by close to 60%, actually 59% to be exact. Well, it is close to negative 55%. As you notice in the wall, these opportunities could have been amazing chances for many investors to get into the stock and buy that. Similar to many other Canadian banks, Royal Bank of Canada did not cut its dividend. They have been paying their dividend straight for the past 27 years. In the past 11 years, they've increased their dividend year after year. Royal Bank of Canada pay $3.76 annual in terms of dividend, and they pay their dividend quarterly in the months of February, May, August, and November. Looking at valuation metrics, Royal Bank of Canada's dividend yield of 3.56% is about in line with their 5-year average of 3.85, suggesting the stock may be reasonably valued today. Also worthwhile mentioning that their sector price to earnings ratio forward PE of 12.1 is well above their 5-year average of 11.1, but it is less than that of the sector's financial sector's 13. The stock's price is hovering closer to its 52-week price range, with the lowest price range being at $80.87 and highest being at $107.75 in US dollars. Looking at the other financial metrics, earnings per share, similar story to TD, whereby the 2021, they had the highest earnings per share reported at $11.20. Their next 12 months is also estimated to be hovering around the same amount. In terms of outstanding shares, the number of last 12 months outstanding shares is at $1.43 billion, which is the lowest it has been in the past 8 to 10 years since 2012. In terms of total sales, we see a nice steady growth, with the only exception of 2020, which was a challenging year for many businesses. The last 12 months, their total sales is at $50.4 billion. And lastly, return on equity, a wonderful story. The last 12 months showing a 17% return on equity, well exceeding that of 9% desirable for banks. Let us take a look at the stock return over the past 1 year as well as the past 5 years. In the past 1 year, Royal Bank of Canada was up by 28.55%, a remarkable 1-year return. And if you look at the past 5 year, the stock was up by 50.55%, close to 51%. This does not take into account your dividend. The dividend is on top of these returns. This is just solely based on the stock return, which is just incredible. Next, we're going to take a look at analyst estimates. Analysts on tip ranks, with 8 of them covering the stock, 6 of them having a buy rating, and 2 of them hold rating, giving the stock a strong buy, with the price target expected to be an average of $111.69, suggesting an upside of 5.88%. Analysts on Yahoo Finance have a price target of $113.42 1 year, and analysts on Simply Wall Street suggest that the stock is undervalued by over 30%, with a fair valuation of $151.59. There you have it, folks. A quick look and review of two undervalued dividend stocks in financial sector. Both of them are Canadian banks that are also available for investors outside of Canada, available through New York Stock Exchange. Hope you found this video beneficial and gained something of value from it. If you did, please be sure to give this video a thumbs up and share it with someone who might benefit from the video as well. Would love to hear from you. Are you invested in any financials and banks? We would love to hear from you. Let us know what Canadian or non-Canadian banks or financial sector stocks are you're invested in. Be sure to let us know. By the way, don't forget to subscribe to our channel here on Moementum Finance and Investing channel. We post every week several videos about investing, whether it's investing in the stock market, real estate, as well as cryptocurrencies, as well as ways to reach financial freedom. Thank you, and we hope to see you next time.